You see, obtaining wealth, it's a marathon. It's never a sprint like a lot of people think. And the problem is most people never, ever see what staying consistent actually looks like over time. So that's what I want to talk about in this video. So in today's video, what I thought I would do is I would show you 3 real financial realities. Realities that you could be living in the next 10 years. So in other words, if you started your private banking system today, same strategy, same concept, but 3 different funding levels. That's what we're going to look at. We're going to look at someone putting in $1,000 a month into their own private banking system, the specially designed whole lives. Then we're going to look at someone starting with $10,000 up front, a dump in, and $2,000 a month. And the last one, we're going to look at someone aggressively putting in $50,000 up front and $3,000 a month. Now listen carefully. These numbers are based on actual policy designs. They are not guaranteed. The dividends are not guaranteed, but the contractual interest rates are. And your results, depending on the policy that is designed for you and how you use it specifically, may vary. But I'm going to show you what 10 years of this structure by being consistent can actually look like. No hype, no fantasy, just math and time. So the first one I want to show you is $1,000 a month funding. That's $12,000 a year in premium deposits. And I'm going to show you what happens in the 10th year of this policy. We're going to look at the liquidity, the returns, and your efficiency in this policy. Let's dive in. And I want to preface, all these examples are showing it without borrowing, without cycling the capital, and without arbitrage, just disciplined funding. Now I know we're going to dive into these 3 different examples with different funding levels, but I wanted to just kind of take a second and talk about the fundamentals, and that is banking. You must understand how banking works in order to apply the infinite banking concept, and it's simple. You do this every day, but let me just walk you through it really quick. You earn money. You go out there and you make money in your job, your business, your side hustle, whatever. And you take that money and you deposit it into a traditional bank. Now, a lot of times people do this for one of many reasons, but the interest rate they're earning on that bank account is usually one of them. I doubt you're going to find banks today in 2026 paying 4%. Let's just assume that they are paying you 4%. And the other reason people love bank accounts is the money's liquid. Well, to a certain extent. But let me ask you this question. When you deposit money in the bank, when the bank has your money, are you in control of that money? Now, many of you are going to say yes, but the answer is truly no, and I'll prove that. When the money goes into the bank, to the bank, your deposit is a liability. But the bank is an expert at taking your money, your deposit, and turning it around into an asset. And they do that by sending your money out to work. So you think you're in control because, well, I can look up my account balance. I can take the money out if I want. But does the bank call you when they lend your money out? Being serious. If you were in control of your money, wouldn't the bank have to pick the phone up and say, hey, just wondering, that $100,000 you just deposited in the bank, can we lend that out on a house in Gettsville, New York? They don't call you an asset. Do they ask if they can lend your money on a car or a home remodel or debt consolidation? No, they do not. They just do it. They take your hard-earned dollars and they send your hard-earned dollars out to work for them in the form of loans. And one of those loans is mortgages, one of the lowest risk loans because they've got the house as collateral. Now let's just talk about that. You put 100 in the bank pays you 4. The bank takes your money and lends it out on this first lien position mortgage on a house at 7%. The bank's making 7, you're making 4. Isn't the bank making more than you are? Yeah, they're making the spread. That's pretty cool, huh? All right, well now the bank has done such a good job that when the bank gives the attorney or title company the cash to buy this house, it goes back to the seller just puts it back in their bank. And the bank's like, hey, thanks. I'm gonna take that money and I'm gonna lend that money back out to someone that wants to buy a car. Again, turning liabilities into assets. Person buying a car, the car's got wheels. It's still an asset that they can collateralize, but it's got wheels, can move around. So they're gonna charge a little bit more interest. They're paying you 4, they're charging somebody 8 on this car loan. They're making a 4% spread. But hold on, it gets better. The car dealership gets the funds from the car loan, puts it right back in the bank. Bank flips it around, lends it out to someone on a home remodel loan. But now this is a second position HELOC. So they're gonna charge 9%. And these rates aren't too far off of today's rates. Contractor gets the money. Sometimes they put it back in the bank, sometimes they don't, but we'll pretend they do. Bank turns around, lends that money back out to someone that's got debt consolidation loan. But debt consolidation loan, that could be a riskier loan. No real collateral outside of personal liability or a personal guarantee. So they charge 12%. The credit cards get the money that the bank lent to the person who was in debt, and the credit cards put the money back in the bank. All the while, the bank has made your money go to work for them. And you are sitting there thinking, oh, wow, I'm getting 4% on my money in the bank. Man, I'm crushing it. Are you really? Because the bank made a spread all the way around. If we add up all these spreads, I'll save you the time, but the bank made 20%. The bank made 20, you made 4. Don't you want to be the bank now? But see, it gets better. If we take the 4 you're making and we divide it into the 20, the bank made 5 times more than you did. Or in other words, the bank made 500% more than you did on your money. Your money that earlier you said you were in control of, but I just showed you, you are not. And because you're not in control, and because the bank knows how to make your money go to work by being a bank and doing banking things, the bank goes out there and makes 20% and you made 4. This is exactly where we need to start questioning this and start saying, you know what? I think I want to be the bank. I think I want to create my own private banking system. I think I want to be in control of my money. So let's dive in to the first example of you being in control of your money with just $1,000 a month going into your private banking system. And what is your private banking system? By now, you should know this. It is a specially designed and engineered whole life insurance policy from a mutually owned company that pays dividends. And then we're gonna look at everything up to year 10, and we're gonna then layer in the infinite banking concept. So you can do what a bank does, but you can take back the banking functions in your life. Let's dive in. So this policy design, there is no dumping. Okay, this is pretty bare bone basic. And I also want to preface, yes, I'm showing $1,000 a month going in, but you listen, your number could be less, your number could be more. This is just an example. But if you put the 12,000 into this particular design, which is 80% of your $1,000 a month is going to the paid up additions rider. That's the high early cash value component in the early years, but in the later years, the paid up additions can be a lot less effective than the 20% you're putting into the base. But we want to design it so that you can use it immediately for the needs and goals that you have in your life. But if you put 12 grand into this policy, you have about 96.72 at the end of the year after you receive your dividend. So some of you would be like, okay, that's good. And I would say that is actually pretty good. But you also got a death benefit of $242,000. Now this is on a 41-year-old male in good health, okay? But I told you I wanted to talk about what happened after the 10th year. What I want you to look at is I want you to look at the 3rd year, okay? In the 3rd year, one thing has happened. If you look over here, you can see this green column. Now this is the Vault software, and the Vault software takes your illustration, we scan it in, and it will now show you your efficiency points. So we know any period after the 3rd year, you are in the efficiency zone. So what does that mean? Simple. You put in $1,000, or in this case, this is yearly, you put in $12,000 over the year. If you put in $12,000, you have made more than $12,000. Matter of fact, that $12,000 you put in the 4th year is now growing by $12,334. So you technically made $334 on your $12,000. But a lot of people wouldn't look at that as the efficiency point. They would look at a cumulative return, okay? Especially if you're putting the money in the policy and leaving it sit and not using it for the infinite banking concept. So we usually look at multiple returns to show different things. This is what they call the cash on cash return. So you made 2.8% cash on cash in the 4th year of the policy, but you cumulatively have not broken even until the 6th year. So in this design, in the 6th year, or anytime after the 6th year, every dollar you put into the policy up to that period of time, now you've made more than the total amount you've put in. So see the difference? Cumulative, total amount put in at any given period of time. So you have to know that this policy cumulatively breaks even after the 6th year, but if you're using it for infinite banking, your cash on cash efficiency point is in or after the 3rd year, in the 4th year technically. Follow that? So now when we come down here to year number 10, this is where it gets really interesting. See, in the 10th year, we've put $12,000 in every year up to this point. So you got 120 grand you've put into the policy. How much cash value do you have in the policy after that? 135 and change. So you see, you've made money on this policy, you've broken even, but here's the other cool thing. At any time after, and we did this here, see this dividend column, I just want to point this out in the 5th year. The 5th year, your dividend, and dividends are not guaranteed, they do change. So I'm just showing you if everything was exactly the same all the way up to this point in time in the 5th year, your dividend is $25.59, which would be enough to pay that base premium. So your policy technically could self-sustain. Now, that is if dividends remain the same and all that, yada, yada, yada. But now, again, back to the 10th year. The 10th year in this policy is incredibly efficient. Your cash on cash return is over 30%. Okay, you can see that right from the screen, over 30%. Your cumulative return in the 10th year is 12%. So your money over that period of time has made 12% cumulatively. Or cash on cash is another, I love that one because that's if you're using the infinite banking concept. So these are really, really good metrics. And I made a mistake a second ago. I was showing you the 9th year's cash on cash at 36. I'm sorry, the 10th year is over 42%. How about those apples? In 1 year, your cash on cash went from 36 to 42%, from year 9 to 10. How can that be? Well, it's easy. It's called compounding interest. And that is the whole reason why people look at this. Now, the other thing you'd want to look at over here is your death benefit started at roughly $242,000 in the first year. In the 10th year, your death benefit is almost, well, it is a little over $452,000. That's because your dividends are buying additional paid up additions, driving your death benefit back up. But at the end of the day, remember we said with this one, after the 10th year, you're pushing over $135,000 in cash value, and it's growing tremendously. I mean, look at year 20, you look at year 30. I mean, I know we're getting crazy, but you got to understand, these policies become incredibly useful and effective the later in the years you go. I'm not saying this policy wouldn't have worked in the first year, but look at how much more effective this small policy would have been in those later years. All right, now that we've talked about that first example, let's move on to the second one. So if you've made it this far, congratulations. That means you're serious about learning this stuff. So do me a favor right now. Hit that subscribe button. That's how we built this channel to the point where it is. It helps me reach more people who need to know and understand how money actually works. And also right above, there's a little bell. What I need you to do is smash that bell so you're notified every time I put out new content. Now, the second person we're going to look at is $10,000 upfront. We call that a dump in. And then $2,000 every month in premium deposits. So $24,000 every single year is going into this. The total paid in after 10 years would be $250,000. So let's look at what this looks like after the 10th year. Again, same strategy, just more capital, more control, and slightly more return. So the unique thing about this second example, we're doing the same thing, 41-year-old male, 80-20 split between PUA and base. But what we did here is we dumped in $10,000 in the first year. So you had 10 grand in your right pocket, you just took it out and you put it in your left pocket, being the policy. We call that a dump in deposit. And then every single month, in this one, we're putting $2,000 a month in. I don't want to get too crazy with this because the numbers aren't too far off. Your cash on cash efficiency is the 3rd year like it was in the last one. Your cumulative break even comes in the 6th year again, but your returns are much higher and you had more cash to use. So if you were going to use this for bigger purchases, this could be small private lending deals. This could be paying off a car. Because that dump in went in, it supercharges the policy, gets it off to a faster start, and it's all just compounding interest, folks. But the other thing it does is it jumps the death benefit. That $10,000 got you over $500,000 in death benefit, as you can see. And then if we go down here to the 10th year, in the 10th year, you're just under $1 million. But you also have to understand, in the 11th year, we're going to drop the term insurance rider, which is going to bring that death benefit back down. So we can see how that works by the illustration, but you don't have to do that. That's optional. but I'm illustrating it that way so we have consistency across these three. But you can see now after the 10th year, let's just kind of glance down. We'll go to the 10th year. Your cumulative return is now 14.3%. Your cash on cash is 45%. And this thing is humming along. Your dividends in the 5th year were enough to make your base premium deposit. So this is a really good design. And this is a design we see quite often. But you know what? Each design we do is built specifically for that client's needs and goals. So the third example, what we're gonna look at is a $50,000 dump in and $3,000 in premium deposits. This is a more aggressive case because over the 10 years, you will have put in $410,000. So let's dive in and let me show you the illustration and exactly how this one really starts to cruise after the 10th year. All right, so now we're in the final design. Again, all things remain the same. 41-year-old male. We got $50,000 dump in going into the policy and $3,000 every single month going in. Now again, we can design your policy to be whatever numbers you want as long as they're within the MEC guidelines. I'm not going to get into that today, but this policy is built within the MEC guidelines, which means the policy will grow. The internal buildup of the cash value will remain tax-free the way these are all designed. But let's just kind of go into this. The first year in this one, we're putting in a lot more money. But because we're putting in a lot more money, what's gonna happen is we have more money to use. But by the time we hit year 2, we immediately, every year there on out, we're gonna be in that cash on cash efficiency zone like we show right there. But the other cool part here is we moved up a year from the efficiency. That's because of the larger dump in. But now, look at this. If we come over here and we look at the dividend, but look at this, in the 4th year, the dividend is now much higher because you had more compounding happening on that big dump in that you did of 50,000 bucks. But the thing that I really love about this design is look at where we hit our cumulative efficiency point. In the 5th year, you have literally gotten all your money back that you put into this policy. So it took you 5 years to hit that cumulative efficiency point. But think about that. You put money in for 5 years. And now you know that every year beyond that 5th year, as long as dividends remain constant with what we are, every year beyond that, every dollar you put in, you're making more than what you put in, cumulatively. So, as R. Nelson Nash always said, after that point, how much did this over $1 million death benefit cost you? He always said, nothing. Well, it cost you something because you had to put money in for the first 5 years in order to get to that point, but now the compounding interest of the policy design is now taken over, and now you've got one amazing tailwind behind your back that is going to push you through. This policy every year beyond the 10th year is a monster. Look at this, 17+% cumulative return at that point, 51.9% cash on cash return. And the next year, in the 11th year, when we drop that PUA, look what happens. 22% cumulative return, 324.3% cash on cash return. Because we got rid of that term rider. We didn't need on the policy. We only had it there so that the policy did not MEC. Because with the large dump-ins, you have to have a term rider on most designs to keep the policy so it doesn't MEC. All I wanted to do with these examples, and I know we went through them relatively quickly, is I wanted to show you, if you just look at 3 different designs, all years, but mostly focusing on the 10th year and beyond, you can see the efficiencies and how the dump-ins make a difference, but you also can see how fast your returns start to climb. Just look at these numbers. Start focusing on the numbers of the cumulative return, the cash on cash return, and look at your death benefit. Even though we drop a bunch of the death benefit right here after we don't need it anymore, so after the 10th year, it still continues to climb. This is an amazing policy design. And if you have the means to do something like this, please let us design it. Right up above, you could click that link and schedule a call with one of our team members, but also you should watch the video that we play at the end of this because it's gonna really show you how now we can take these policy designs, these specially designed whole life policies, and apply the infinite banking concepts and make way more money. That is nearly $500,000 of liquid capital inside your private contract. Now, it is very important that you understand something. These numbers assume there are no policy loans, no outside investments, no capital cycling, no arbitrage, no velocity. This is just the engine idling. This is just putting money in the specially designed whole life and letting it sit. But let's talk a little bit about what happens if you apply the infinite banking concepts, because that's where things really start to change. Going back to person number one, where they were putting $1,000 a month in. What if you took loans from the policy to pay off consumer debt? What if you financed your vehicles? What if you eliminated auto loans that you currently have? What if you controlled the repayment terms on those loans and you stopped fetting the bank's interest? At this level, you stop borrowing from the banks for personal purchases. You start financing your life through your own private banking system. Now the second person, remember that was $10,000 in a dump-in, $2,000 a month. How about this one? You start using it to purchase real estate. How about start a business? Use it for down payments, bridge capital, business expansion, or just private lending. Acting fast when opportunities show up because you're liquid, you have the cash. This level turns your policy into investment opportunity capital. Now the third example was a $50,000 dump-in, $3,000 in premium deposits. This one gives you the opportunity to operate like a true private banking system. You can have multiple simultaneous loans. You can start doing big private lending deals or multiple lending deals. You got all sorts of arbitrage opportunities. The capital is always working for you. And at this level, you're not using the banks. You're replacing them. The simple progression from the first example to the second example to the third example is control your personal financing. Take back the banking functions in your life and then control your capital ecosystem. You see, the infinite banking concepts, that process allows you to scale with contributions. The more capital you warehouse early on, the more control you're going to gain later. And just remember this, what you just saw, that is showing you only 10 years. Imagine this at 20 years. Imagine this at 30 years. Imagine this is a volatility buffer for your retirement, a supplemental income for your retirement. This is what compounding gets to do. It has a real job. When compounding has real time to do its job, that is when it becomes amazing. And you know what? If this is something you want to explore, the next simple is super simple. Right above, book a call with my team. There's also been a QR code on the screen. You can just scan that little thing. And you know what? If you're thinking, I'll have to wait until I have some more money saved up, you're wrong. We can build your policy to meet your funding levels. And understand this, the best time to start is now. The policies are flexible. They can certainly grow as your income grows. We can design more policies and add multiple policies to grow with your capital. Heck, you can start policies for your kids. You see, this is not a product. It is an infrastructure for your personal finances. You know what? This next video right here, The Secrets of the Wealthy, shows you how this strategy helps you take back control of your money. And you know what? It's a great starting place. I'll see you there.